Adrian Mowat, emerging market equity strategist. Adrian, is it all clear blue skies for emerging markets, and within that for India, because valuations may be expensive, but the promise of growth and underlying businesses is also very strong?
Well, I think there's really two questions there. The outlook for EM in 2019, I do think is good. And I'll build that up from a number of different markets. The largest market in EM is China, had an extremely difficult 2018 with the MSCI China down more than 20%, the onshore Shanghai market down some 30%. We had a very tight financial conditions, a slowdown in economic growth, a reduction in the overall industrial profit numbers for China in 2018, and that was reflected in the market. Looking into 2019, I think there are two key drivers. One is going to be a stabilization in the economy because of policy to stimulate growth. Part of that policy to stimulate growth is a reduction in both personal as well as corporate taxes. And so I think the earnings outlook for China could look very favorable in 2019 relative to expectations. The next two biggest markets are Korea and Taiwan, also performed very poorly last year because of the trade war. Remember that most of the listed companies in Asia that are vulnerable to export disruption through trade disputes are in Korea and Taiwan. So if we can get some resolution in that, that would be very helpful for those markets. In Brazil, the policies of the government are viewed to be pro-growth, pro-reform, including privatization. So I think when you put these things together, the chances of EM outperforming are pretty good. The other factors, which I think you're alluding to before my segment, was just highlighting the views around the Fed and the dollar. So with the Fed moving less than they did in the last 12 months, combined with less dollar strength, that'll be broadly favorable to the emerging markets with current account deficits. I don't think India will be an outperformer in 2019 if China's growth does recover and profits recover and we get a resolution in the trade dispute. India was a big outperformer last year. Positioning in India is bullish, overweight within dedicated emerging market funds. So I think it's a good year for EM, but India probably lags that.
Right. Adrian, hi, morning. We've got another event coming up less than a fortnight from now. We'll have a truncated budget event as well. Do you expect anything out of the box or any adverse policy announcement coming in from the government? Although it's unlikely, but considering it's so close to election, most people are expecting that it's going to be extremely pro-farmer and a very populist budget announcement that the government would actually table this time.
Yes, so there might be an upside surprise here in that the expectation is a politically focused budget, one targeted for policies that are deemed to be popular. Possibly, if policies are more muted, then that could be a positive news story for the market.
Right. Adrian, I know you maybe have been asked this question many times, but even so, how do you look at India's investment profile? And I know that you are not building in a case of a major outperformance by India within EMs, but even so, if historically we go by data which indicates that election years are rewarding years for Indian investors, how would you look at the kind of returns the markets can generate given the elections lined up for mid of this year?
Yes, so my expectation is that the Indian market does go up this year, but probably lags emerging markets if we get the conditions I was talking about for China, Korea, and Taiwan, plus Brazil. The interesting thing in India is, do you change the strategy that worked in 2018? And so in 2018, we had a big outperformance of the exporters in terms of the IT sector. We had good performance out of the more blue chip banks. But then we had significant underperformance of some of the more cyclical sectors, such as autos and two-wheelers. And perhaps the story for 2019 is that inflationary concerns continue to moderate, expectations around the RBI are less severe, and that you also get some pro-rural income policies. And I think if that comes through, then the weakness that we've been seeing in the auto and two-wheeler sector is an opportunity to add some exposure to that. So you get a little bit more domestic cyclical exposure responding to a more favorable real income story in India.
Adrian, if I have to, let's say, paint a rosy scenario, or if I have to look at world from rose-tinted glasses, can I say that the trade war fear will not get diluted? The concerns in China, which are centered around trade war, shadow banking and debt, they will not get resolved. Fed will not tighten, and markets which are expensive but markets which give you durable and reasonable growth, let's say India, or for that matter, any other emerging market, they may have a serious scope of outperforming. I mean, can I look at a rosy scenario of the world?
I'm not sure if I understand what your rose-tinted glasses are. You're telling me that trade disputes continue, China doesn't get resolved. That doesn't seem very optimistic. I actually think that the balance of probability is you do get some resolution around the trade disputes. So really you're kind of turning the temperature down as opposed to completely resolving the issue. With regards to China, I think it's got medium-term to long-term structural issues which will continue to cause a growth deceleration on a trend basis. But 2019 might be a year of cyclical uplift. And then if we go and look at this in the context of India, as I look through the EM active managers, they do on average seem to be overweight India. India was a good place to be overweight last year. I think it's going to be difficult for India to outperform because it doesn't really have the significant delta of moving from a negative to a positive that some of the other major EMs have.
Crucial would be the election outlook for Indian investors. In the short term, based on historical data, we know that election could be a swing event of 5 to 15%. Do you think we should wait and watch and come back at higher prices rather than second guessing the outcome of elections?
I think the outlook for equity markets for the first quarter will be pretty good globally. So I wouldn't be recommending people stand on the sidelines. It may be the case that by the time we get to March, markets are a bit higher, and the prudent risk-adjusted thing to do is to take some money off the table in India. But let's have a discussion about that in late March rather than in late January.
Follow-up there, Adrian, is, because these conversations have already started, from an investor standpoint, what is a make or a break moment when it comes to the expectations from the poll outcome for allocations to India, to decide on whether to increase them or not?
So in talking to global investors, the view is that the current administration is still in power post the election. So people are viewing this as a neutral event, no major change in policy. The risk, obviously, with that view is that either there is a change in government or that the BJP-led coalition comes back to power with a significantly reduced majority or even forced into a coalition. And I think that would be a downside risk to the market. So as I look at the poll event, it's a downside risk if it is going to be a market moving event. But at the moment, people are running a base case of no change in the administration.
So, Adrian, looking at the market dynamics and, of course, the government stance as well, you know, it's a given that it's the rural growth that the government wants to be pushing, or at least wants to be seen pushing. In that lieu, would you say that maybe increasing exposure to some of the rural themes would be a prudent strategy as well, at least in the run-up to the state elections, or rather the general elections?
Yes, it would be prudent to do that. And you know, in looking at that exposure, you're thinking here about two-wheelers, you're thinking about tractors. Now, the question is whether you're also going to throw in fast-moving consumer goods to that. They were relatively good performers last year, quite defensive, and probably aren't going to have the level of beta that you would get in consumer discretionary. The issue for the Nifty index is the Nifty index has a relatively low exposure to these domestic cyclicals. It's got quite a high exposure to export earnings and to more defensive earnings. And then within the financials, there's a very large distribution of results across the bank. So generalizing with the banks is quite difficult.
Okay, and just, you know, as an extension to budget expectations and what investors are working with currently, I've been trying to gather more opinion on the fixation that the market has with India's fiscal prudence measures and essentially managing the fiscal deficit, as also what, you know, the budget might state in terms of growth projections for the economy. On both those parameters, what is it that one is penciling in, and what is it that the markets would be okay with?
So again, I would sort of highlight that the base case here from international investors is a populist budget, just considering where it is in the election cycle. Obviously, if the budget comes out with a significant increase in the projected fiscal deficit, that might be viewed as a negative, probably would be reflected more dramatically in the bond market. But in thinking about what EM investors are focused on at the moment, they're tending to view India as much more steady as you go, a more predictable entity, and that the attention is on events going on in other major equity markets in EM.
Adrian, if in this budget the government chooses to lean on the politics and less on the economics, which means a farm loan waiver stroke a subsidy or some grant is coming. This grant or subsidy will come at a cost which will have impact on expenditure and it will have impact on fiscal deficit. Is that negative for an economy like India, for a market like India, where the fiscal discipline has been okay but now could get compromised?
Yes, it is a clear negative. So it's a negative in terms of the fiscal impact. It's also a negative in terms of financial development. If you develop a culture where people can borrow money, then expect to be forgiven, you're going to struggle to develop a rural financial system that is robust, vibrant, that has the proper considerations in it. So it is clearly a negative. It's a possibility because these often happen ahead of an election.
Okay, Adrian, lovely speaking with you this morning. Thanks very much for joining us and have a lovely day.
Thank you.